Evening, everyone. Welcome to the first Finance Lecture Series 2020, organized by I Am Code. We are honored to have with us Mr. M. Damodaran for inaugurating the Finance Lecture Series. Today's session is moderated by Professor Ramkumar Kakani, Professor of Finance, Accounting and Control. Now hand over the stage to Professor Ramkumar Kakani to take it forward.
Thank you, Professor Raju. Thank you, Nishan, and thank you, Professor Jijo. It is my fortune and pleasure to introduce Sri Damodaran sir. And given his Tendulkar type of career which he's got, to kind of just quickly introduce, becoming an IAS officer itself is a very one in a million kind of a thing. And within that, he holds the record of being the youngest chief secretary for a youngest person ever in India to hold such a position for the state of Tripura in the 1990s, that is 1992 to be specific, which is considered a leadership peak. Chief secretary is considered to be a leadership peak for IAS officers. Moving from there, in 2001, when UTI was in bad shape, Unit Trust of India, Sri Damodaran sir came and ensured a very solid turnaround for the organization. So much so that he was also given the charge of IDBI simultaneously to manage such a large organization. And if turning around two giant financial institutions was, if one thought was big enough, then in 2005, he took over as SEBI chairperson and had a stint till 2008, wherein he introduced some wonderful corporate governance norms. One of the biggest being the introduction of QIP, when there was none in those days. Moving from there, Sri Damodaran sir, if one thought that he probably will be hanging up the boots and taking retirement, no, and that is the best part of it. And he is, as on date, on the board of some of the biggest organizations in India, Larsen & Toubro, Hero Motors, Tech Mahindra, Biocon, CRISIL, to name a few. And he's also, ladies and gentlemen, he's also the chairman of Indico from 2019 onwards. So, ladies and gentlemen, and on behalf of IMCOI Code, I would like to request Professor Damodaran sir to please have a 30-minute talk, which will be followed by another 30 minutes of questions and answers. Sir, all yours.
Professor Raju, Professor Katani, Professor Jiju Lokos, Nishant, other faculty members, and my dear students. Firstly, let me congratulate IIM Kozhikode on something that I had not known about earlier, which is the completion of 25 years, your first jubilee. I think it's a time to be jubilant, it's a time to celebrate, it's a time to take stock of what has gone by in the past. And then, like Donald Bradman did every time he scored a century, take guard and then play for the next 100 runs. That is where the Institute is, and I'm delighted to be part of an effort to launch a new program and to share some thoughts on a subject that is very, very dear to my mind and heart, which is the future of regulation in the financial sector. I'm not concerned with what regulation is like at this point of time. What interests me is what it will be like 3 years from now, 5 years from now, or what it should be like 5 years from now. I don't know whether we will get there. So what I'm going to share with you in the next half an hour or so is a wish list of where I wish to see the regulatory landscape in the financial sector. Let me start by very briefly commenting on and putting aside something that has been tried worldwide and given up without much of an effort because it didn't succeed, and that is the concept of self-regulation. We always hear that there is no need for external regulation. Why can't people regulate themselves and their activities? They know best what should be done. Why do you believe that every person needs a framework of law or regulation administered by an external source to ensure that we stay on the straight and narrow path? Why is that necessary? I don't want to get into the theory of this, but if you look around the world, look closely in India, and I'll give you just one example. One example which the Prime Minister commented on not so long ago, which is self-regulation by the Institute of Chartered Accountants of India. With facts and figures, he took apart the exercise of disciplinary powers by the Institute and said that if this is the way you're regulating your profession, you are not going to create trust in your profession. You're not going to create confidence in the audit reports that you churn out. And the audit reports are very, very important documents based on which you and I judge a company and perhaps take our investment decisions or our exit decisions. So that's one example of self-regulation that didn't take off. The other is the Association of Mutual Funds of India, which wanted to become a self-regulator. But when you have a trade body, a body of professionals, which for good reasons looks after its own interests, it cannot regulate and provide justice and equity to the stakeholders that it deals with and for whom it exists. So I don't believe we should pursue that option, which is of self-regulation. We should look at what I call meaningful and pragmatic regulation. We shouldn't have too much of regulations, but we should have a lot of regulation. And I'll get to that in just 1 minute. But why regulation? To begin with, why regulation? If we claim that we are civilized people, that we live in an orderly society, we should know the rules by which games are played in the orderly society. It cannot be that if I am a player, I set my rules, I decide what I will do and cause harm and hurt to you in the process. That cannot be the object of regulation. So regulations must be clear, they must be transparent, they must be understandable, and every player who is expected to act on the basis of those regulations should start with the assumption that I know what I'm required to do, because that is what the regulation of the law requires me to do. And that is the way I will conduct myself going forward. The financial sector is seeing changes at a fairly rapid pace, and Professor Gijo Lucas referred to the way we transact with financial institutions as customers. The intermediaries in the market have changed. They're all corporate entities for the last few years. They are certainly far more professional and rely more on reason and logic than instinct, as was the practice earlier. The instruments are changing. There are newer and newer instruments. And the players that were there in the marketplace earlier have given way to another set of people, younger, faster, more ambitious, more aspirational, more demanding, persons that will not take less than the best. They are the ones in the market. And it is in that market that regulation should coexist with the market, should provide a meaningful framework of laws and regulations, and should be both feared and respected. There are three elements in human relationships: fear, affection, and respect. The regulator will never get affection, certainly not while he's sitting on the chair. But it's enough if you can, create fear in the minds of those that want to cross the lines of propriety and law, and get the support of people that want you to do the right things, not just in your interest, but also in their interest. So the instruments are changing, institutions are reinventing themselves. We have one problem in India, not just in India, but to a lesser extent in some other countries, which is earlier we used to say, give me a problem and I'll find you a solution. Then we got to give me a problem and I will give you an institution. If you think of modern bakeries, see, the quality of bread in London was very poor at a point of time. What did people in London do? They ensured that the quality improved by looking at what went into the bread, where was it sourced, how was it stored, how was it handled at the time bread was manufactured, and they managed to fix the quality. We created modern bakeries. Our response was, let's have an institution that will deal with providing quality bread. So at the drop of a hat, we create institutions. If you fast forward in the regulatory space, we had to begin with the Reserve Bank of India of 1934 vintage. Then we had SEBI 1992. The Insurance Regulatory Authority came later. And then we gave ourselves a pension authority, and that, to my mind, is a function that could have been regulated as much by the IRDA as by a new authority. And you didn't need a new authority, but you created a new authority. The only good thing that has happened in the history of financial sector regulation is that we have folded our commodity market regulation into SEBI and created one securities market regulator that handles, even in the US, it's not combined. Chicago regulates commodity trade, New York regulates the securities market trade. That integration hasn't happened. I think it's a good thing it's happened here because a plethora of regulatory institutions is not the answer to the requirement of good regulation. What you need is write the laws clearly, implement them clearly, decide objectively, implement passionately. That ought to be the view of all regulatory organizations. Decisions must be objective, but the enforcement function must be driven so that it cannot suffer from a dilatory process. Over a period of time, what has happened, both as far as laws are concerned and as far as regulations are concerned, is we add new laws, new regulations, but we don't take away those that have become irrelevant. I'll give you one example. Many years ago, but long after the Second World War, war allowance used to be paid till 1980s in some manufacturing units. The war was over long ago. It was over even before I was born. The war allowance continued to be paid because it was a subject of some regulation and it didn't occur to anybody to take it off. You could get an allowance for dog walkers. You could engage a person to walk your dog and there would be an allowance paid to you. That law went much later. But let me give you the most hilarious example, which is reported to have happened here in Delhi, which is that there is a rule which says that any place that provides food on payment must also have a source of water that horses can access. Now, nobody goes to hotels and horses any longer, at least in the major metropolitan cities, but the law remained. And apparently 10 years ago, a very intelligent police officer, sub-inspector or inspector, decided to visit a five-star hotel. And after he had consumed what he needed to, when the bill was proffered to him, he said, I am in the police, I don't pay these bills. Whereupon the manager came and said, there is no exemption for you, you have to pay it. And this fellow knew the law. So he said, okay, under such and such act, there is a provision which says that you must have a source of water for horses to drink. You show me where that is. Are you compliant with the law? Which is the first time the manager had heard about the law. I mean, how many of us know about these laws, right? The manager was equally smart. There's no shortage of smart people. He said, sir, first you bring the horse, we'll find the water, not an issue. But after some time, when pressed, he said, we have a swimming pool, there's no problem. The horse can drink as much water as it wants to from there. We have no issue with that. But the point I'm making is that remained a law on the statute books till a few years ago, when in one good enlightened move, the government took away hundreds of old laws from the statute books. This was one law that went away. Of course, this is not a law that intelligent police inspectors can use any longer. But I'm telling you how ridiculous laws and regulations can be if they outlive their requirement. So you need to deal with, going forward, you need to deal with the stock element of regulation and the flow element of regulation. You have a lot of regulations today as we speak. You have a lot of regulations relating to banking, to securities markets. Luckily, insurance is a Johnny come lately, therefore you don't have too many past regulations. They are still in the process of catching up with the others. But if you look at both SEBI and the RBI, there is a mountain of regulations, most of which have outlived the utility. And you need to actually take them out and replace them with something that is relevant, something that meets contemporary requirements, something that actually enables business to be conducted consistent with the regulatory landscape. Because today, many of the regulations are inconsistent with the needs of business. They are actually obstacles, they're obstructions. They must be got out of the way. How do we do that? And this is one of the things that I want to see going forward. There must be a regulatory review authority in every regulatory organization. That regulatory review authority must look at what is presently available throughout all of those that are past the sell-by date, modify those that are still relevant but need to be tweaked to meet present-day needs, and then craft maybe master circulars, master regulations, which address a much wider range than the bits and pieces regulations that you have today. Because there used to be a story told immediately after the financial meltdown in 2008, when, among others, regulators were also blamed for what had gone wrong for the meltdown in the financial sector. Rightly blamed. I'm not saying for a moment that regulators did not deserve their share of blame. What did the regulatory community worldwide do, especially in the financial sector? They started writing regulations like there's no tomorrow. So I was in a conference sometime and somebody asked me, long after I had superannuated, somebody asked me, what do you do when you wake up every morning and find that the regulations have changed? So I couldn't give him a serious answer. I said, when you wake up before the regulator wakes up, because that's the only way the yesterday's regulations will be valid, at least for a few hours. But you are having regulations like there is no tomorrow. You keep writing regulations. That's not the answer. Every time a murder is committed, we don't amend the Indian Penal Code. The police catches, or hopefully catches the murderer, gets him tried, convicted, and then he either goes to jail or gets hanged or whatever. But you don't change the law. You don't change the definition of culpable homicide every time a murder is committed. Why do you need to rewrite the regulations every time there is an episode of misconduct in the marketplace? You don't need to rewrite that. You see whether your existing regulations are good enough. And very often they are. So you need to have a regulatory review authority that will address the stock element of regulation by cleaning it up. That same authority should also function as a regulatory preview authority. What does a regulatory preview authority do? Before a regulation takes effect, when it is in the stage of consultations with stakeholders, there are discussion papers put up, views come back, you factor them in, etc. That final product should be run past a regulatory review authority, because that authority will ask itself one question, which is this problem that we are trying to address now a problem that can be addressed by any of our existing regulations? Then we don't need new regulations. Why, suddenly release into the marketplace, much like, Shakespeare's great comment, mischief thou art afoot, take what course thou wilt. Just release one more regulation and see what the tamasha is. That should not be the objective of regulation. See whether existing regulations take place. From my own experience, I can tell you something. There was a time when the mutual fund industry was in bad shape. So what happened was that people who were selling mutual fund products decided that you needed to bring new products in their own interest, not in the interest of the investors, because a new product will get you better commissions. So you take the person out of an existing product and bring him or her into a new product which has much the same features. It's not new, except that shall we say, the bottle is new, the contents are the same. So these NFOs, or new fund offerings, as they're called, initially they wanted to call them IPOs, but there was so much confusion that I insisted you can't call them IPOs. That's another animal altogether. So they were called new fund offerings, NFOs. And we got the trustees to certify every time that a new product came that there is no existing product in a suite of products that addresses this particular requirement or provides this particular combination of services and returns. Only then we said we would clear it. Much the same approach must apply to regulation, that you must see, does any of my existing regulation meet this requirement? If so, I don't need a new regulation. We don't do that often enough. So you need to take out the stock, you need to take out the flow element by keeping a control on the new regulations that come into the system. Both of these are important. The other point is, and this is something that has been talked about for years, but not much has been done, is a phenomenon called regulatory impact assessment. If you don't do a regulatory impact assessment, because regulation seeks to serve a purpose, we got to balance that purpose with the cost that is paid. At the end of the day, no intermediary pays the price. All these regulations are written to protect you and me as customers, as investors, as policy holders, whatever, as depositors in banks. And we pay the price for it, because if the intermediaries did not incur costs, they would give us better returns. But some of the money that is due to us has gone in the process of intermediation. So all regulations, all laws are written in order to benefit us. And yet, if the impact is so minimal and the costs are high, it's certainly not worth the trade-off. And therefore, you should have something called a regulatory impact assessment for every piece of regulation, so that if it passes that test, it becomes regulation. If it doesn't, goes back to the drawing board to see how can you do it better in a more cost-effective fashion or in a more impactful fashion. One of those two objectives must be met before you unleash a new set of regulations. Now, if you look at our laws, legislative drafting, and I wish someday IIM Kozhikode, when it becomes a fully multidisciplinary university, as the new education policy wants all institutes of higher learning to be, will have a school of law that specializes in legislative drafting. Our laws are drafted so badly that very often even those that draft the law don't understand what the intent of the law is. Forget you and me, who are supposed to read it and understand it. And the cardinal principle all over the world is that ignorance of law is no excuse. My answer to that to all lawmakers has been, and I've canvassed this for years, I've said, if ignorance of law is no excuse, write laws in a simple language that I can understand, so that I have no excuse to be ignorant. If you write it in complex sentences that don't have a beginning and an end, clearly you can't expect the average man to understand that. And for every law, I don't have to go to a lawyer and pay top dollar to understand what you can tell me in simple language. That is something I think that we need to focus on. I am associated with a project which is rewriting regulations in simple English. Only simple sentences can be used, no compound sentences, no complex sentences. So a lawyer friend of mine, he was my executive director when I was in SEBI, he's now set up his own practice some years ago. He and I are working on this with the top law schools in the country to get students to rewrite this, because they are the future lawyers. Get them to rewrite this in simple sentences. Existing laws that run into several clauses and maybe are 10, 12 lines, just one sentence. You don't know where it started, where it ended, what it said in between. I don't want to take your time by giving you examples of this. The other problem that we have, and therefore, every authority also should have, the income tax has it, but it has only limited effect. Every authority that writes regulations must have an authority for advance rulings. If I am going to do something, if I am going to raise capital and I'm going to do it through a new instrument about the legality of which I'm not sure, it seems right to me, but I don't know whether I will fall foul of any provision of any existing regulation. There must be a body within that regulatory body to which I can go and say, this is what I want to do. Tell me, am I doing the right thing or the wrong thing? I must get an advance ruling so that before I invest money, I know that I am on the right side of the law. In income tax, you can do that, but the income tax officers have found their way of getting around it. They will take 6 months to give you the decision, by which time your timelines for filing returns and all of that have disappeared. So there is a body, but it doesn't do much. You need an effective body. What today happens in some organizations is you get something called informal guidance. That it is informal, and it says so, it's informal. Now you act on that basis and somebody issues you a notice, you say, but I got my informal guidance. They will tell you, but you didn't come to us. You went to the other division in the organization. They must have given you guidance. So this must be an authority that binds the entirety of the organization. It can't play departmental games or divisional games so that, somebody says you can do this and somebody else says. And all of what I'm sharing with you now is what is happening now. 5 years from now, do I want to see that? My wish list says, I don't want to see that. What is the instrument I will put in place? That instrument will be the authority for advance rulings. Then look at laws in the banking sector. In the banking sector, you start with the Banking Regulation Act of 1929. 1929 is ancient Indian history, long before we became independent. Then you have the RBI Act of 1934, and since you are students of finance, I would urge you, read the preamble to the RBI Act. It will give you the impression that it was meant to be a temporary institution responding to the Bretton Woods Conference and to bring monetary stability in most countries of the world. But the 1934 Act still holds good, and it is on that basis that we are going. When India became, in 1997, when we had celebrated 50 years of independence, the then Speaker of the Lok Sabha, Purna Sangma, said he wanted suggestions on what should be done to remember 50 years of independence. At that time, we were all asked, and I suggested that the RBI Act should be scrapped and we should have a new RBI Act, a new Banking Regulation Act. Of course, like most such suggestions, it didn't see the light of day. So we continue to have the same RBI Act with all manner of complications sitting inside that. After that came the State Bank of India Act 1955, the State Bank Associate Banks Act of 56, where banks like the State Bank of Travancore were involved. Of course, all of them are now history. They have been folded into the parent bank, the State Bank of India. Then you had the two nationalization acts, 1970, replacing an ordinance of 69, and 1980. And then you had several other acts to create special categories of banks. Now, what has happened as a result of all of this? The provisions in many of these are inconsistent with one another. So you have something in the SBI Act, something in the Banking Regulation Act, and now something in the SEBI LODR, the listing obligations and disclosure requirements. That is a regulation. The State Bank of India Act is a statute, and statute has a higher ranking in the hierarchy of laws, rules, regulations. The statute comes above, even though it's prior in point of time. So there is a carve out. Now, SEBI wants to lay down the same guidelines for everybody. The State Bank says, This doesn't apply to me because my State Bank of India Act says something else. For something as fundamental as the composition of the board of directors, banks have provisions in their acts which are different from what the SEBI says. Now, clearly, this can't continue indefinitely. And my suggestion, therefore, is, and I hope that this will see the light of day, is that you must have only two acts. One act to regulate structure, one act to regulate function. So you have the Companies Act, which regulates structure because most of these are listed entities. They have to comply with the listing obligations. And you have the Banking Regulation Act, which should be actually rewritten to meet contemporary requirements, and that will regulate the functioning of banks. If you have a third act, with parts of which are inconsistent with these two, clearly you're not going to get anywhere. And that is something which I hope will happen in the course of the next few years. Then there must be several attributes that all laws and regulations must have. There must be clarity, of course, as I mentioned. There must be certainty that it applies, and there must be continuity. You can't keep changing them every time. Like our Income Tax Act, for example, every year it gets changed. You cannot do any long-term fiscal planning by looking at the Income Tax Act because you don't know what's going to change in the coming year. And the last thing that I need for regulation as a wish list is that every regulation must have a sunset clause. Why do I say this? I do a lot of consulting for boards. I discover the policy documents. I discover things that they are regulating their conduct and their functioning by. And many of them are ancient. They're not relevant to what happens now. And yet, they are the ones that are being followed. And obviously, there's a lot of discomfort arising out of that. Why is that happening? Because once you put that regulation in the book of regulations, you don't revisit that. You think, I have a regulation to address this. Take insider trading, for example, in the securities market. Prohibition of insider trading provisions are relatively new. But you had prevention of insider trading earlier. Now it's prohibition. The content also has undergone change, and it takes a while for most people to catch up with that. Supposing you had a sunset clause which said, at the end of 5 years, this regulation will cease to be valid. You are obliged to revisit that regulation, and if it is still relevant in the present form, continue it for as long as you want, another 5 years, another 10 years. But you're obliged to revisit it so that you examine it for contemporary relevance. If that doesn't exist, you will write one, it will be cast in stone, and while the business will be conducted consistent with the requirements of the marketplace, your regulations will be looking in some other direction. And God forbid you get a regulator waking up on the wrong side of the bed, he will throw that regulation at you, and you can't complain it's outdated. Why? Because that is the regulation. So we need to have regulations that are fewer in number, better enforced, clearly drafted, are valid for reasonably long periods so as to provide continuity, with a cleaning out of the existing stock element which doesn't need to exist, regulating the flow element through the regulatory preview authority, and giving me comfort I'm doing the right thing by having the authority for advance rulings in place. That is what I thought I will share with you today. I hope some of you students will get into the area of regulation at some point of time. And then, if by then this has not happened, please give it a good shot. I'm telling you, there will be great value in the community that you seek to serve. Thank you very much.
Thank you, sir, for such a wonderful and passionate set of words that you mentioned. Some of the things which I can clearly reflect is less regulations, less regulations, but more regulated. That is more regulation. The other is essentially legislative drafting to be in very simple language. Many other things were mentioned. The one more was essentially try to have only two acts. And the last was something which was very impactful, wherein you mentioned have a sunset clause whenever there are regulations. So these are the few very big take homes out there, and of course there are many more. So Nishant, over to you for Q&A.
Yes, sir. Sir, we have got some questions from my batchmates. I'll tell you all the questions which I got. The first one, very first question is from Vishal. It is regarding the COVID situation. So, post-COVID, what kind of changes are expected from the regulatory bodies? Given the amount of disturbance COVID has caused and a lot of mid or small-sized companies, future looks bleak. So, sir, your point, sir.
I think very briefly stated what you are seeing, especially from the banking regulator, because that is where the hurt is more, because smaller entities that have loans on their books that cannot repay in time because of the lockdowns, because business suffered a lot. They are the ones that need help. And you have seen RBI coming in with regulatory forbearance, giving extended timelines. Of course, the one negative impact is that the Supreme Court has also gotten to the act now, instead of leaving it to the regulator to take a final call and deciding what should be the timelines for classification of assets as non-performing assets, etc. But regulatory forbearance is the regulatory response to problems faced by situations like COVID. You will find all regulators, insurance regulator, for example, has postponed the last dates for payment and said, if you have not paid some of your premium, annual premium, there is no problem. You will not be called a defaulter. You will get an extended lease. That is the answer, really. Other than that, you don't need to write fresh regulations. That's not the answer.
Okay. Thank you, sir. Sir, the other question which I got from Shivang is related to the timings which, sir, in 2018, SEBI had permitted stock exchanges and brokers to allow trading from 9 a.m. to 11 p.m. to facilitate traders from foreign countries. What are the issues that brokers faced due to which implementation was not possible for the same? And what will be the changes that SEBI will have to incorporate for regulating the trades in the extended hours?
You see, not just with reference to this question, but generally, you cannot write regulations in the rarefied atmosphere of a regulator's office, because there cannot be a disconnect between ground realities and regulations. If that disconnect exists, then clearly you have a problem, because business will get obstructed. At the end of the day, why does regulation exist? Regulation is not an end in itself. It's a means to an end. It is to ensure orderly conduct in the marketplace. It is to ensure that there is a level playing field, that no one person, because he or she has benefit of information that somebody else does not have, exploits that asymmetry of information. It is to rule out conflicts of interest so that those who are conflicted do not enrich themselves at the expense of others. So if regulation is the means, and these are the ends which are sought to be achieved, clearly this can be achieved only if there is a continuing conversation with the stakeholders. And what most regulatory organizations do before they introduce changes is to have an exercise of consultation with the regulated universe, with the people who know where the shoe pinches. You will find, whether it's the Reserve Bank of India or whether it is SEBI or the IRBA, discussion papers are put out and you can comment on. The one tragedy in our country especially is, even if you give a month for that, very few people respond. The minute it becomes final and takes effect, everybody then starts finding fault with the regulation. But you had a whole month where you could have expressed the views you don't express, or you believe somebody else will state it. Why do I need to waste my time? But when then things get crystallized, and you have a problem with that. So the changing of timings, all of these are matters which at one level have arisen because consultations have taken place. You need to protect your markets. You need to develop your markets. If you look at the preamble to the SEBI Act, there are three objectives in the preamble on why SEBI was created. One is development of the market. One is regulation of the market. The third, into which both regulation and development feed, is protection of the interests of investors. Development is an activity that protects investors because if you have a large market with larger number of players, larger number of people that come to your market, more products on offer, more companies that are listed, and in that large mass, you get a kind of a stability which translates to investor protection. If just take 5 years ago, when Indian funds were smaller and less active in the market, if for some reason the FIIs pulled the money out of the market, your market tanked. Because FIIs pulled the money. No self-respecting market can have a disproportionate foreign influence on the way it functions. You need to have a counterbalance of a domestic presence, whether it is domestic retail or domestic institutions, which then keep your market in a reasonable state. I'm not saying for a moment that because foreigners exist, Indian institutions must jump in and buy, or that somebody from Delhi should telephone LIC and say, please buy these and keep the market up. I'm not into that. But opportunities will present themselves and Indian institutions must seize those opportunities. Indian retail investors who earlier were very shy to get into the market, they are there in larger numbers today and they are invested a little more, not as much as required. You need to see a lot more presence. So talking in terms of market hours, trading hours, you see the windows for block transactions, the window for bulk deals, all of these have undergone changes from time to time, depending on experience. This is the continuing exercise, but in that process, some brokers who are late will then complain, late in sense of adopting to a new hours, will complain, no, this is a bad thing. Some of those who are smarter and are prepared for it because there is a consultation period that precedes this. They will be all right. I don't think we should worry too much. These things will stabilize.
Okay. Okay, sir. Thank you, sir. Sir, we have a question regarding cryptocurrency from Keshav and Vatsala. Similar questions we got. The RBI earlier this year gave a kind of green note to cryptocurrency. Do you think over-regulating digital innovations such as these might lead to India being left behind in this space?
The short answer is over-regulation will leave you behind.
Yes, sir.
Anything that is excessive, even if it's good food that is excessive, is harmful for the system. Over-regulation is definitely harmful for the system, no question about it. The bigger problem is that when regulation is misinterpreted to mean control and micromanagement, it gets worse. A regulator in a football field, a referee is not supposed to put on boots and kick the ball. But unfortunately, some regulators tend to become players sometimes. And that becomes a problem because your job is to make sure what the regulations are and blow the whistle when somebody steps out of line. That's your job. It is not to actively aid the game, support one side, grant this exemption, that extension. Then you don't need laws. It is meant to have a level playing field. Now, cryptocurrency, interestingly, if you look at the history of cryptocurrency, and I'm sure the person who asked the question must have seen this. Cryptocurrency was the answer to what I might call the incompetence of banks to intermediate properly and in real time. Because banks were not a part of the equation in cryptocurrency. The problem again there was that you had approvals from a lot of people that needed to kick in real time so as to legitimize transactions. It was not one person who okayed it. There's a bunch of people unknown to you who okayed the transactions. I think at some stage RBI was talking about having its own cryptocurrency. because it didn't want to have the things that had come out. That exercise was abandoned. Then finding that, the problem again in the United States was, at the end of the day, a currency is a medium. It is not the commodity. It is the medium through which transactions are done. If somebody uses cryptocurrency to use for drug trade, the problem is not with cryptocurrency. It is with why you use it. You can very well use legitimate currency for a drug trade. You can't blame the currency for it. It is a drug trade that is the problem. But there were cases registered against people who were the early birds in cryptocurrency. There were cases registered against them because of the application of cryptocurrency.
Okay.
You see, it's the same atom bomb principle. The atom was a very good discovery. But if you use it to drop atom bomb in Hiroshima and Nagasaki, that's not such a good thing. So you blame somebody for the objective, but you can't blame the basis that went. So RBI issued an order saying banks will not deal with this and will get no support. What did they do? These are clever people. They relocated to Singapore and Dubai because cryptocurrency need not respect national boundaries. If they find that the environment is hostile somewhere, they can relocate somewhere else. So they went and set up exchanges elsewhere. It's not that they shut shop here. Then the matter went to the Supreme Court, where they had challenged the correctness of RBI's order banning cryptocurrency. And the Supreme Court raised some questions about why should you ban, why can't you regulate cryptocurrency? Which is when RBI has now reluctantly said, okay, we will look at how this can be used. The other problem was that because cryptocurrency had a negative connotation and cryptocurrency had underlying it the blockchain also got a bad name in our country at one stage because they thought these were inseparable twins. They're not. These are completely different things. But because you use blockchain to further the cause of cryptocurrency, it doesn't mean that any taint that might get attached to cryptocurrency, wrongly in my view, should impact blockchain. Today, we are not blaming blockchain for anything. It has got relief it's got disconnected. I think a few years from now, you will find with all its problems, cryptocurrency having some space in the mediums that we use to transact business.
Okay, sir. Okay, sir. Sir, we have a question about merging regulators. Like there was a situation, the Justice Sri Krishna Committee suggested a united financial regulator by merging multiple regulators together. So this is broadly in line with your theme for the talk. But why hasn't the government done till now?
Okay, it's a good question. It is not what Sri Krishna said in the FSLR report, is not what I am saying. I am saying don't keep on adding more regulators. Sri Krishna says take all the existing regulators and fold them into one regulator, which has huge problems. Each of these institutions comes with a certain history, with a certain, let's say, reservoir of institutional knowledge and memory. You can't negate that by mixing everything together. You see what happened post-2008 in London. Over a weekend, the Northern Rock disappeared. Why? Because there were three regulators. There was a banking regulator, and there were a couple of other regulators involved. There's a Bank of England involved, and they did not talk to each other over the weekend, even though the problem came over the weekend, and Monday morning, Northern Rock blew up. The response was, let's integrate all these people. Where are we now? Do we have an integrated regulator in the UK? We don't. We've discovered that integrated regulators also come with problems. Therefore, you have park something somewhere else. Second, for all that we may blame RBI, it wears multiple hats. It is the monetary authority. It is a banker to the government. It is the bank. It regulates the banking sector. It is the the equivalent of the lender of last resort in a sense. Some of these are interrelated functions. If you have a banking space where RBI has no role in regulation, the interconnect between monetary policy and banking regulation will disappear. Because banks are the instruments through which the transmission takes place. You can't afford to keep banks out, banking regulator out, and do something in isolation. And what is important to remember is there should not be a disconnect between the universe that you seek to regulate and the regulatory entity. In your MBA oath, you say that you should not have a disconnect between word and deed. I extend it further to say you should not have a disconnect between thought and word and between word and deed. These disconnects are critical. This is the same disconnect that will hit regulation.
Okay, sir. Sir, we have many questions. I'll be taking some few questions. Sir, can we take more questions?
I am okay. It depends on you. You people have other work to do. I am a retired man.
Yes, sir, but I think maybe you would like to have a cup of water or something like that, just to kind of.
All done. It's here.
Okay, sir. Okay.
Okay, sir. Sir, the next question we have from Abhijit is regarding the frauds which are happening these days. The exact question is, stakeholders place complete faith on the expertise and the wisdom of the auditors, independent directors, rating agencies, and even regulators in some instances. But every scandal from Satyam to Yes Bank further erodes our faith in them. Is is the corporate governance scenario in the country festering and crumbling beyond repair? How do we restore the credibility and glory of these institutions back? So this is one question.
Don't lose hope, Abhijit. India's corporate governance standards, while they are not exceptional, while they are not very good, while they are not where they ought to be, are at least as good as the standards in several other countries. Sometimes I get asked this post Satyam when I was in a few conferences abroad, people ask me, interestingly, persons of Indian origin more than the others, that, things are terrible in India. See, Satyam happens there. I said, you have forgotten Enron, Global Crossing, Tyco, you've forgotten all of that, Parmalat in Europe. Only Satyam you remember, nothing else. Things have happened in your backyard, but that you don't think is important enough. Every day there is. Volkswagen putting out deficient vehicles in the market, defective vehicles in the market is a corporate governance. You knew that it was wrong, and yet you didn't blow the whistle, you put it out in the market. So standards should improve. Corporate governance will always be work in progress. But as far as audit quality is concerned, we need to travel much, much further. The auditors unfortunately believe that the management that hands out their engagement letter is their client. The auditor's client is the shareholder community and the extended stakeholder community. It is to them that the auditor presents the report, which is a part of the annual report put out by the companies every year. In that report, if you don't say what you have noted, if you pull your punches, and management will plead with you, don't qualify this report, we will have problems, don't modify it, there will be trade-offs, there's an animal called emphasis of matter. They will say, don't qualify, put this under emphasis of matter, so that is not treated as a qualification. All these fun and games will be played. If you see the 3 judgments that have come out of the NFRA regarding Deloitte partners, 3 of them separately, and they have been suspended from practice, fairly hefty fines have been imposed on them. What is the commonality? They said that they failed on 2 counts, independence and professionalism. An auditor is supposed to certify independence when it takes up the function of audit, that it is independent of the auditee. How do you get independent of the auditee? You get in, we are not talking about blood relationships here, with the auditor being somebody's younger brother or not. Those in any case shouldn't be encouraged. But independence of the auditee means that you will not take up non-audit services. If you go back to what happened with Arthur Andersen and Enron, Arthur Andersen's earnings from non-audit services, from consultancy services, were more than their earnings from audit fees, and therefore the quality of audit suffered. In these cases, again, what they do, what auditors do, is there is this large network. These are global networks, whether it's PwC, EY, KPMG, Deloitte. These are global networks. Then you have audit firms that are members of those networks. So you will get an SR Bartley Boy or a Ferguson or some other entity which does the audit. And the non-audit services will be done under the auspices of this parent. And then you claim, no, we are different entities. You are not. You belong to that network. You are not a different entity. What happened in Satyam, PricewaterhouseCoopers claimed that the audit was done by Lovelock and Lewis. We didn't do the audit because it was signed as Lovelock and Lewis. But they are an entity under the PwC umbrella. So unless the audit quality is tightened, unless auditors give you a true and fair account of what they have found, they have any number of excuses, any number of disclaimers, but you've got to see through that. And audit committees must challenge auditors. Today, audit committees are saying, I hope this meeting gets over and this fellow doesn't raise any problem. That's not the purpose of the audit committee. The purpose of the audit committee is to challenge the auditor. Tell us what is it that we need to look for. Tell us what is it that you've seen that's not in your report. So you are right. Frauds will happen if auditors don't take preventive measures, managements don't take preventive measures. And what is worse, don't take post-event measures. That after the fraud has happened, you don't move quickly enough and put in place what needs to be done. People tend to get encouraged. Now, sitting on top of all of this is a legal system where cases take 20 years. So the guy that whether he does a financial fraud or commits a crime, he knows that if he has the money to go to the highest court, 20 years he can ride out the system before the final conviction comes. These are the issues we need to address. You people are young people. I hope in your India, these issues will get addressed.
Thank you, sir. Thank you, sir. Sir, okay, so we are over with the questions now. Now, I would like to thank you for such an insightful session. And we are grateful for the time and effort you took to share your thoughts and experiences. I believe we all can benefit immediately from the methods you suggested. Thank you, sir. Thank you again for your contribution. And now I request everyone to stand for the national anthem.
Thank you, Nishant. Thank you. Thank you, professors.
Thank you, sir. Thank you so much. Sir, I hope we get a chance to meet you in person and thank you in person.
So you'll have to put COVID behind you first.
We'll do that, sir. We'll do that.
Okay, lovely. Thank you. Thank you. I'll sign off. Thank you.
Thank you.
Thank you.